Welcome to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on this, the 5th day of March, 2019. I always like to remind you that I publish a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and you can subscribe to that by going to miningstocks.com, or call our office here in New York during normal work hours, 718-457-1426, 718-457-1426. Also like to encourage you to consider subscribing to my friend Chen Lin's letter. Chen is publishes What is Chen Buying, What is Chen Selling, has a brilliant track record, especially in the biotech sector, but also covers energy and the mining sector as well, especially precious metals mining. What is Chen Buying, What is Chen Selling? Go to chenpicks.com, chenpicks.com, and also always like to remind you of Michael Oliver, who's with us in just a few minutes to give us his latest take on some of the most important markets that we follow. OliverMSA.com, OliverMSA.com is where you should go to sign up for a subscription to Michael Oliver's letter. I want to thank you all for listening to this show, making it one of the more popular shows in the Voice America Business Channel. Also, like to encourage you to continue your questions and comments coming our way. You can send them to questionsfortaylor@gmail.com, questions, the number 4, Taylor@gmail.com. And of course, we do want to thank our sponsors for making this show economically viable. Without them, we would not be talking to you, I dare say. Novo Resources, Triumph Gold, Gold Mining Inc., Uranium Energy, Miramont Resources, Great Bear Resources, and Klondike Gold are the companies that are sponsoring this show this week. And I did get a chance to meet with several of them up in Toronto over the weekend at the Prospectors and Developers Conference and also at the Metals Investor Forum. I have titled today's show, A Return to the Gold Standard. Are you kidding me? Is that even possible? Alistair MacLeod and Michael Oliver return as guests, and Bill Pincus, he's the president and CEO of Miramont Resources, appears for the first time to talk about one of my favorite stock picks in my newsletter, Jay Taylor's Gold, Energy, and Tech Stocks. That's Miramont Resources. Alistair says that a return to a gold standard is the only way nations can contain the interest cost of servicing debt. The only alternative, he says, is inflationist policies that can only lead to far higher interest rates and currency destruction. Alistair opines that the upcoming credit crisis is likely to kill the welfare state model in the West by destroying their unbacked paper currencies, while at the same time, China, Russia, and their Asian allies have the means to prosper. Well, that sounds a little strange to those of us who are inundated day after day with Western propaganda, but we'll hear what Alistair has to say about that. Well, what happens to the dollar if the U.S. opts to take the short-term easy way out, that is by printing more and more money? And how should investors respond? Well, we're going to be talking to Alistair in the second half of today's show for answers to those questions. Bill Pincus will be with me right after our first break. But right now, I'm pleased to tell you that Michael Oliver is with me once again to talk about his views on the gold markets and other markets that are extremely important to us. Thanks for being with us again, Michael.
Hi, Jay.
Good to have you. Good to hear your voice again, as always, the reassuring voice. But more than that, I must say, people that listen to you every week have no idea, unless they subscribe to your letter, either of your great letters, your services, the larger one that covers many different markets, or the one that's more focused on gold and silver. As I was telling Michael right before we went live here today, that one of the things I really appreciate about him as much as anything is the stability that he provides, the stability in terms of his advice that he gives. And I think the momentum work that he does has been very, very helpful to me because it helps to show you, I get sort of a sense of the foundational strength or weakness of a market, and that to me is very helpful. Otherwise, if I were just watching the price charts, I would be very nervous. I would be in and out. I'd be second guessing myself all the time. Am I on the right side of the market or not? And Michael, thanks so much for being with me again to help us stabilize us at a time when gold has had a little bit of a pullback here. You know, I just came back from the Metals Investor Forum, as I mentioned, in Toronto, also the Prospectors and Developers Association show in Toronto. It's one of the world's largest, if not the largest, mining sector shows in the world. And the mood was, if quite subdued by gold bugs, if not outright pessimistic, because they've seen the price of gold kiss that 5-year ceiling once again. Many times it's gone up there and touched it and bounced right back down. So they're sort of despondent and sort of feeling like, yeah, there's no hope here. We're never going to go anywhere significant in the gold market. What can you tell listeners out there that have made bets on the long side of the gold market, but who are a bit depressed by gold's recent decline?
Well, this past weekend we did something we normally don't do, and that is we actually focused on price action. And I think we had a weekly chart going back 5 or 6 years. And once gold crashed in 2013, the rally highs after that all crested in the mid to upper 1300s. And that's the line you're talking about that everybody can see now. You can be an amateur chartist with a crayon, and you can see the line. Mm-hmm. And what we noted was that coming off of the bear lows, late 2015, into the rally that peaked in mid-2016, and coming off of that deep secondary low back in late 2016 that got all the way down to, I think, 1120 area, and then turned back up, went again to the mid-1300s, and then comparing it with the recent one that came from the 1160 low last August, and again went back up to the mid-1300s. The tonal difference in price in those two prior surges that got up into that level was markedly different than this time around. They took a longer time to get there, and they had $100 corrections en route going from the 1100s up into the 1300s. In fact, one of the rallies, the one that came off of the December 2016 low, took it a full year to reach its peak, and there were two $100 sell-offs in the process of getting there. $100 pullbacks in the process of getting to that line. This time, there were none. We had any jiggle we had from the August low last year up to the 1345 high we made 2 weeks ago was so trivial it almost didn't show up. It might have consisted of 1% here or there. Finally, we got a reflective action off of that line again. So far, it's consisted of, 60 some odd dollars. And right now we're trading about $12.88 on gold, and the high trade was $13.45. So the tone of getting back to that line again, which we shouldn't have done. We shouldn't have come back up to that line again if we didn't have the intent to go through. And I think that the intent is to go through. But finally, you did have a genuflex at the line. I call it an idiot line because any idiot could see it. And so far, the pullback is far less serious than any of the pullbacks in those two other advances. So, in other words, the tone under the market, the bidding, is more resolute and is not waiting for such a sharp drop to find, to enter the market and bid for it. Before, $200, $100 drops in late 2016, early 2017. This time, finally, they got a 60-point pullback. We think that line, if you were a bear on gold, and this is August of last year, we're down near 1160, yeah, it might have had a rally from that low, just because it was a bit oversold at that point, but it shouldn't have come all the way back up to the high again. That indicates there was not enough resistance to stop it until you got back up again to the idiot line. So something's going on there, tone-wise, in the gold market that nobody's speaking about. The fact that it was able to get back there with such ease, it finally did have a little bit of a stumble here, but we suspect that we're going through that line.
Right.
And from our momentum stuff, our momentum is all positive.
Your momentum is still positive. It's almost no change.
The only thing that turned negative was daily momentum, and that's logical. Day-to-day measurements of the momentum action. And frankly, it's ripe to turn back up now, the daily momentum. I feel bad for the gold bears because they don't seem to realize what just happened between last August low and the high of 2 weeks ago, how easy it was to get back up to that high without flinching. That says something. And yet nobody seems to notice the tone.
All right, Michael, with regard to the gold shares then, how are they performing during this
They're behaving well.
pullback?
They're behaving quite well. Yes, they did pull back $1.50 in the GDX recently, but it's above our levels of breakout on momentum that occurred down around $20 on the GDX, by the way. And I think we're trading in the high 21s right now, almost 22. And so, yes, it pulled back, but for us, it's green lights, period.
Yeah.
Yes, you had a pullback. The problem with pullbacks is if you don't get in at the right time, the pullbacks hurt. And unfortunately, I think a lot of the gold bugs buy strength rather than buying weakness. And therefore, their average entry price is, on the upper end of a recent range than at the lower end. And that's hopefully what momentum can provide is earlier entry points.
Exactly.
Into the resurrection.
Exactly. Yeah, and we've seen it time after time. Not, we focus mostly on the gold market in this show, but I watch your other markets, and time after time, momentum gets you in at an earlier price and out at a higher price. And it really has worked, and that's why we have you here every week, as often as we can anyway. Michael, with just a minute, less than 2 minutes left, the S&P 500, now, you published a daily momentum chart on your 360 weekend report that showed momentum holding firm support on the zero line. Of all the markets you frequently report on, the S&P is the one that seems to resist market laws most. What would it take for you to join the U.S. equity market bulls?
I would say it's virtually impossible. The damage that's been done to us, if we were bullish on stocks, and we are, by the way, we're bullish on emerging markets in China. We called China 2,500, upper 2,500s on Shanghai a couple months ago, and it's just traded up to 3,000 now.
Yes.
And it's behaving quite well. And I think on a relative basis, if you must own stocks, fine. Own emerging markets, and like the EEM is the ETF emerging markets, 30-some-odd% of it consists of Chinese stocks. And own China. But owning the developed markets, which have been inflated ever since at least 2011 through, the recent highs by central banks, you're buying into something that has been blown up in terms of price levels by fiat currency games, interest rate games, and so forth. Yes, the Chinese engage in that, but a little less frequently, actually, than we do. And so on a relative basis, if you want to own stocks, own emerging markets, which are commodity-related often, and own China, as opposed to owning the S&P 500 or the DAX index in Germany.
All right.
But
very good, Michael. We'll have to leave it go at that. We're out of time right now for this segment, but thank you so much for your wisdom. It's always greatly appreciated, I know, not only by me, but by most of my listeners. So thanks again for being with us.
Thanks, Jay.